All right, so the IRS just dropped some brand new guidance on a whole new way for kids to save for the future. Today, we are going to break down exactly what these so-called Trump accounts are, how they work, and what it all means, pulling directly from the official notice. Let's dive in. So there's a new law out there officially called the One Big Beautiful Bill Act, and it's created a completely new kind of financial tool. The IRS has now released the official rulebook for how these accounts are going to work, and that's exactly what we're going to walk through today. So what in the world is a Trump account? Well, according to the IRS, you can think of it like a traditional IRA, but it's built from the ground up just for a minor. And the most important thing to get your head around is that it lives in two different phases. First, there's this super regulated growth period before the kid turns 18, and then there's a whole new set of rules after that. Okay, so that's the big question, right? How does this thing actually work in the real world? The easiest way to understand it is to just follow the account's life story, from the moment it's created all the way until its owner becomes an adult. All right, let's kick things off right at the start. How do you even set one of these up, and who's eligible to get one in the first place? So who can get one? Well, the rules are actually pretty simple. The child has to be under 18 in the year you open the account, they've got to have a social security number, and an authorized person, like a parent or a legal guardian, has to be the one to officially start the process for them. Now here's where it gets really interesting. There's a pilot program designed to get these accounts off the ground. The IRS notice says that for eligible kids born between 2025 and 2028, the government itself will drop a one-time payment of $1,000 right into their new Trump account. And how do you actually open one? The process is laid out pretty clearly. An authorized person makes the choice, and they'll do it either by filing a new form, that's IRS Form 4547, or by using a new website, trumpaccounts.gov, which they expect to have up and running around the middle of 2026. After that, the Treasury Department basically takes it from there and works with a financial institution to get the account officially created. Okay, so the account is set up. What happens next? We enter what the IRS is calling the growth years. This is the whole period before the beneficiary turns 18, and it's got a very, very strict set of rules. During this phase, while the kid's growing up, there are basically 5 different ways money can flow into the account. You've got that initial $1,000 from the government's pilot program. You could have money come in from states or charities. An employer could make a tax-free contribution. You can roll money over from another Trump account. And of course, the family, parents, grandparents, even the child themselves can put money in. But, and this is a big but, there's a limit. If you combine the money coming from an employer with the money coming from those other sources like mom and dad, you hit a hard cap, and that cap is $5,000 a year. That government and charity money, that doesn't count towards this limit. All right, so you've got money in the account now. Can you just go and invest it in anything you want? Nope, not even close. The IRS guidance makes it very clear that during these growth years, the investment choices are incredibly narrow, and it's all designed for simple, low-cost growth. And they are super specific about the rules here. To be an eligible investment, it has to be a mutual fund or an ETF. It has to track a big, broad U.S. stock index. Think something like the S&P 500. It absolutely cannot use leverage, which is borrowed money. The fees have to be tiny, under 0.1% per year. And you can't pick some niche fund that only focuses on one industry. The whole idea seems to be to keep it simple, keep it diversified, and keep it cheap. And you guessed it, the rules for taking money out are just as strict. The core idea during this growth period is that the money is locked in. It's supposed to sit there and grow, and there are very, very few ways to get it out early. Now, here are those incredibly rare exceptions. You can do a direct transfer to a new Trump account for the same kid. In one specific year, the year the beneficiary turns 17, you can roll the money into an ABLE account for individuals with disabilities. You can take out any extra money that was contributed by mistake, and of course, the money is paid out if the beneficiary passes away. And that's pretty much it. And that brings us to the final chapter of the account's childhood, coming of age. There's a huge shift that happens on January 1st of the year the beneficiary turns 18. The growth period officially ends, and the account changes in some really fundamental ways. This is really the core of the whole thing. The account basically graduates. All those tight investment restrictions, they vanish. You can invest it just like a normal IRA. That special $5,000 contribution limit, gone. It's replaced by the standard IRA contribution rules. And that lockdown on withdrawals, that's lifted too. From now on, it follows all the same distribution rules as any other traditional IRA. but it doesn't just become a totally normal standard IRA. A few key things stick with it for life. For one, it's always officially designated a Trump account. It can never, ever receive money from certain employer retirement plans, like a SEP or a simple IRA. And for tax purposes, the basis, that's the after-tax money that went in, is always tracked separately from any other IRAs the person might have down the road. Okay, we've walked through its whole life, from creation to adulthood. So let's zoom out and hit the big takeaways you really need to remember from all this new IRS guidance. First off, just remember it has two different personalities. The super strict growth period before age 18 with all those guardrails. And then, after 18, it grows up and acts almost exactly like a normal traditional IRA, with just a few little quirks. And, last but not least, a really important date to circle on your calendar. You can't put any money into these accounts before July 4th, 2026. And we'll wrap up with this final thought. The IRS has put these proposed rules out there because they want to hear from the public. They're taking comments until February 20th, 2026. So the question for you to think about is, when you look at all these new rules for contributions, for investments, for withdrawals, which ones do you think are going to have the biggest real-world impact on the families who actually decide to use them?